Welcome to the presentation on the Document Management Systems investor presentation. My name is Khabar Nehal and I represent Applied Technology Research Center. I'm excited to present a unique investment opportunity in a managed services business focused on document management systems. This is not a traditional startup equity round, nor is it a passive fund. It's a rules-based, transparent venture where you can participate economically without taking on management responsibilities. In this presentation, I'll walk you through the opportunity, the share structure, how the pricing works using silver as an objective anchor, when and how you can earn returns, and the simple steps to participate. Everything we discuss is designed for clarity, alignment, and long-term value creation. Let's start with the core opportunity. We operate a managed service business for document management systems. Many organizations, like small businesses, schools, clinics, professional firms, they all need secure, reliable document collaboration, but lack the expertise or bandwidth to manage it themselves. We fill that gap. We select the right document management system platform for each client, deploy it, manage updates and security, provide user support, and ensure compliance with the data protection regulations. Critically, we don't build the software ourselves. We leverage existing open source or commercial platforms which keep our capital requirements low and our risk manageable. We do develop our own proprietary systems for managing these systems. For investors, this means a capital-efficient business model with strong margin potential. You participate in the profits through Class B dividend shares, which we'll explain in detail. Our delivery model leverages skilled, cost-effective talent in lower-cost areas of supply for some aspects while billing global clients. This creates a powerful arbitrage opportunity. Why focus on document management services? That's a good question. The demand is universal and growing. Every organization, from a single person to 5-person startup to a multinational corporation, creates and relies on documents. These assets need to be stored securely, shared appropriately, version controlled, and protected against loss or breach. At the same time, regulatory frameworks in many countries and many areas and industries impose stricter requirements on how data is handled. Many organizations want to move to cloud-based collaboration but lack the technical staff to manage it properly. And unfortunately, data breaches and accidental deletions are all too common. Our service addresses all of these pain points. We become our client's trusted partner for document infrastructure. This creates high client retention. Once we are managing their critical documents, they are unlikely to switch. That translates to predictable recurring revenue, which is the foundation for sustainable dividend distributions to you, which is our investors, and the people who are participating in the project. Our delivery model is designed for efficiency and scalability. Our operational baseline is Karachi, Pakistan, where we have deep roots through ATRC, operating since 1992. Karachi offers access to highly skilled IT professionals at cost structures that allow us to deliver enterprise-grade services at competitive rates. For specialized needs like complex integrations, security audits, or round-the-clock support, we tap into the global pool of remote contractors. This hybrid model ensures quality without bloating the fixed costs. All client contracts are priced and billed in USD, which provides currency stability for both us and our international clients. We can serve clients anywhere in the world because delivery is remote. We also partner with locals in the different cities and countries so we can provide on-the-ground support. We document service levels in clear service level agreements. Finally, every client engagement is tracked separately using our project equity method system. This means we can isolate risks, measure profitability per client, and even spin out successful engagements as independent projects if needed. This flexibility is a strategic advantage. Now let's talk about how ownership is structured. We use a two-class share system to separate control from economic participation. Class A shares are the control shares. They are held exclusively by the general partner, that is me. These shares carry 100% of the voting power and operational decision-making authority. They do not earn dividends. They are not available for public investment. This ensures that strategic and operational decisions can be made quickly and consistently by the person with the deepest expertise and accountability. Class B shares are dividend shares. These are what you, as an investor, will hold, and also participants. They entitle you to a proportional share of the quarterly profits once the project starts generating revenue. Critically, Class B shares carry zero voting rights. You're not responsible for management decisions. You're not liable for operational risks. They can be transferred to others, but only with written approval from the general partner and the project committee, primarily for compliance and risk management purposes. The key takeaway is this: you can buy Class B shares only. You earn dividends, you do not vote, and you do not manage. Let me elaborate on the Class A shares, the control layer. These shares are held exclusively by the general partner. They confer 100% of the voting power on all material matters, which the document management system platforms we support, which clients we onboard, what pricing we set, how we allocate the budgets, who we hire for key roles, and how we respond to emergencies like security incidents. This concentration of authority is intentional. In professional services, speed and expertise matter more than democratic governance. Having a single accountable decision maker prevents paralysis and ensures consistency. Importantly, Class A shares do not earn dividends. The general partner's economic participation comes exclusively through Class B shares earned via documented work. Class A shares cannot be sold or transferred casually. Any change requires extraordinary circumstances such as general partner incapacity, and even then, successor approval involves the committee and the Class B shareholders. This structure protects investors from opportunistic control changes while ensuring the project always has a clear leadership. Now, Class B shares. This is your vehicle for participation. Anyone can hold Class B shares. External investors like you, the general partner, the committee members, or the team contributors who earn them through work. The core right attached to Class B shares is economic. You receive a proportional share of quarterly profit distributions once the project starts generating revenue. Importantly, all Class B shares are treated equally, whether you bought them with cash, earned them through work, or acquired them via secondary transfer. Your dividend rights are identical. What Class B shares do not provide are the following. The Class B shares do not provide any voting power. You cannot influence which clients we sign, what technology we use, or how we spend the budget. This is by design. You are investing for returns, not on operational responsibility. You can transfer your Class B shares to others, but the transfer requires written approval from both the general partner and the majority of the active committee. This approval is for compliance, identity verification, and risk management, not to control the price you negotiate with your buyer. The key benefit for you is this: it's pure economic exposure to the project's success without management duties, liability, or complexity. Let me explain how new Class B shares enter the system. There are two pathways. The first one is capital investment. When you commit capital to the project, new Class B shares are minted specifically for you. The pricing is simple and objective. Exactly the value of 1 gram of 99.9% fine silver on the day you commit. Sourced from the international global markets for silver. The number of shares you receive is your committed amount divided by the silver price, rounded to 6 digits after the decimal point. The minimum commitment is the value of 1 gram of silver. So at the current prices, for example, you can start with approximately $5. This low threshold makes participation accessible. Importantly, there are no valuation rounds, no negotiated pricing, and no anti-dilution clauses. If the project raises more capital later, new shares will be minted at the then current silver price, and everyone's ownership percentage will adjust proportionally. You can participate in future raises to maintain your proportional stake, but dilution from new capital or work compensation is an accepted feature of this model. The second pathway for creating new Class B shares is work compensation. This applies to the general partner, committee members, or approved team contributors who perform documented work for the project. Each month, work is logged via timesheets or deliverable records valued at the fair market rates. For example, $50 to $150 per hour depending on the role and complexity, and converted into shares using the same silver price formula. For example, if a participant performs work valued at $970 in a month and the silver is $4.85 per gram, 200 new Class B shares are minted and added to the participant's account. For the general partner, this compensation is mandatory and non-waivable. The general partner cannot choose to defer it, take cash instead, or skip a month. This rule exists to ensure the GP is always incentivized to actively work on the project and to align long-term interests. The general partner earns economic participation only through ongoing contribution, not just by holding shares. Importantly, general partner earned shares are Class B, identical to investor shares. They carry dividends but no votes, and they are diluted equally when new shares are minted for others. This creates a powerful alignment. The general partner wants to grow the pie for everyone, not just accumulate shares. Let's discuss why we use silver as our pricing anchor and how the mechanism works. First, why silver? It offers unique advantages for a global rule-based model. Silver is a neutral commodity which is traded on global markets and not controlled by any single government or central bank. Its price is transparent and published by multiple reputable sources. Silver is also less volatile than cryptocurrencies but more universal than any single fiat currency. How does this pricing work? On the day you commit capital or on the work compensation period, we reference the silver price from global markets. Your dividend rights are based on the project's overall profitability, not the silver value. The model is self-balancing. If the silver prices fall, new investors receive more shares per dollar committed, which dilutes existing holders slightly more. If the silver prices rise, new investors receive fewer shares, reducing dilution for existing holders. This dynamic is intentional and accepted by all participants. Now let's clarify what happens before the project generates revenue. This is the investment phase. During this period, no dividends are paid. Your capital is put to work funding the essential building blocks of the business, the infrastructure, the servers, storage, networking via partners, tooling, ticketing systems, monitoring, project equity method integration, compliance, legal templates, data protection frameworks, team training, and initial marketing to acquire pilot clients. Your Class B shares are recorded in the project equity method ledger from day one, and you can view your ownership shares in the dashboard. but these shares do not yet generate cash flow. Importantly, a part of your capital also funds risk mitigation reserves. A buy now, pay later reserve, a contingency reserve, and an operating reserve. These buffers protect future profitability and, by extension, your dividends. The general partner is strongly incentivized to end this phase quickly. The general partner earns Class B shares only through documented work during this period, and no dividends flow until the revenue begins. This alignment ensures relentless focus on acquiring that first paying client. The first revenue trigger is the pivotal moment that activates your economic participation. It is defined precisely. It is the time when the first customer makes a payment. Verified means the funds have cleared. This is not an invoice or a promise, but actual cash in the bank. And also, there is a clearance from the customer that nothing else is left to be done from the company's point of view. The payment must be tied to a formally executed service agreement that is tagged to the project in our project equity method system, ensuring clean accounting. Once this trigger occurs, we notify all Class B holders in writing within 5 business days through email. Behind the scenes, the project equity method system switches its dividend calculation engine from pending to active. Reserve funding, which was previously drawn from investor capital, now transitions to being funded from the project revenue also. Most importantly for you, quarterly profit distributions start. From this point forward, we recognize revenue, deduct operating expenses, fund the required reserves, calculate the net project profit, and distribute 50% of the profit to Class B holders pro rata. The trigger is binary and objective, no ambiguity, no discretion. You'll know exactly when the investment starts giving dividends. Let's walk through exactly how the profits flow to you as a Class B holder. First, we calculate the net project profit each quarter. We start with project revenue for cash that is actually received and cleared from any obligation. This conservative approach protects dividend sustainability. From revenue, we subtract the operating expenses, the infrastructure costs, the labor, the software tools, compliance, certification, and allocated overhead. Next, we fund the required reserves. We also account for depreciation and amortization of equipment and software. What remains is the net project profit. Of this amount, 50% is distributed to the Class B shareholders. The other 50% is retained in the project to fund growth, which is things like client acquisition, tooling upgrades, talent development, or reserve building. Distributions can be paid through bank transfers, money transfers, or digital currency. We provide annual tax documentation for any country that the investor may be in. All Class B holders are treated equally. If the general partner or committee members hold Class B shares, they receive dividends on the exact same terms as you. No preferential shares, no hidden allocations. This alignment ensures everyone is focused on maximizing sustainable profitability. Let's consolidate some essential mechanics that define your experience as a Class B shareholder. First, Primary pricing. Whenever new Class B shares are created for your capital commitments or for general partner work or committee work or work compensation, they are minted at exactly the value of 1 gram of silver on that date. There is no negotiation, no valuation round, no discount, or no premiums. This objectivity removes speculation and keeps the process transparent. Second, secondary transfers. If you wish to sell your Class B shares to another party, you may negotiate any price you agree upon, above, below, or equal to the price that you paid. The project does not track, regulate, or worry about that price currently. In the future, we might provide a system where people can list their shares for sale with bids and offers. However, the transfer shall require written approval from both the general partner and the majority of the active committee. This approval is for compliance purposes to verify the buyer's identity, ensuring that they are not a sanctioned party. As new shares are minted for capital raises or work compensation, the total number of shares count shall increase, and everyone's ownership percentage adjusts proportionally. We do not provide anti-dilution protections. We do not guarantee any specific ownership percentage. We do not issue complex dilution reports. Your ownership for the Class B shares at any moment is simply the number of shares that you have divided by the total number of shares already there, a number displayed for information purposes only. The philosophy is straightforward. You own shares, you earn dividends proportional to your stake, and you accept that as the project grows and issues new shares, your percentage may adjust. The goal is to grow the overall pie, not protect a fixed slice. Now let's cover governance, exit options, and structural flexibility. In governance, the general partner retains 100% of voting control through Class A shares. Class B shareholders have zero voting rights on any matter related to strategy, client selection, technology choices, budget allocation, or personnel decisions. This ensures fast, expert-led decision-making without investor committees slowing execution. Exit pathways. You have 3 options. First, you can sell your Class B shares to a third party, subject to the approval. Second, if the entire project is sold or liquidated, the Class B shareholders receive a 1x return on their original capital before any surplus is distributed pro rata. Class A shares do not participate in the liquidation proceeds. The third option is to simply hold the shares on a long-term basis and collect quarterly dividends, a dividend harvest strategy. Flexibility. Any client engagement can be structured as a separate ring-fenced project within. The flexibility in this system is that any client engagement can be structured as a separate project within the project equity method with its own cap table and economics. This allows risk isolation and targeted investment. Technology neutrality. We are not logged into any specific system. The general partner may migrate clients to better solutions as technology evolves. The client data is always exportable in open standard formats, eliminating vendor lock-in risk. Finally, limited liability. Your maximum loss is the capital you committed. You're not personally liable for the project debts, lawsuits, or obligations beyond your share of ownership. This is contractually guaranteed. Let's articulate why this model is compelling for investors. First, transparency and alignment. Our silver peg pricing mechanism removes the guesswork and negotiation typical of startup investing. There is no debated valuation, no preferred stock terms, no liquidation preferences beyond a simple 1x return. The price is objective, published, and auditable. Second, incentive alignment. The general partner earns economic participation exclusively through documented work contribution. The general partner cannot simply hold shares and collect dividends. They must actively contribute value to earn their Class B allocation. This ensures the operator is always working to grow the business. Third, simplicity. We deliberately avoid complex financial engineering. There are no dilution calculations to explain, no secondary market pricing to monitor, no multi-tiered distribution waterfalls. You own shares. You receive dividends proportional to your stake. That's it. Fourth, global accessibility. With a minimum investment around $5, the acceptance of multiple currencies, participation is open to a broad range of investors. Our remote delivery model means that we can serve clients anywhere, expanding the addressable market. Fifth, project equity management transparency. You receive read-only access to a real-time dashboard showing your share balance, project revenue, and expenses, the buy now, pay later, portfolio health, and the distribution history. Once annual revenue exceeds $100,000, we engage an independent auditor to verify financial statements, adding another layer of trust. Continuing with investor advantages, efficiency and risk mitigation. Capital efficiency is core to our model. We don't build software from scratch. We leverage existing document management system platforms. Infrastructure can be on-premises on the client, it can be our infrastructure, and also we resell infrastructure from other suppliers. So we avoid heavy capital expenditures. We scale costs with demand, adding talent or tools only as the client revenue justifies it. This lean approach preserves capital for growth and dividends. The global arbitrage amplifies the margins. We deliver services using skilled talent in Karachi, where the operational costs are competitive, while billing global clients in the global market rates. This spread creates strong gross margins without compromising quality or support. Risk mitigation is built into the structure. A buy now, pay later reserve, a contingency reserve, and an operating reserve. These buffers protect dividend sustainability. We are also not dependent on a specific technology. This reduces obsolescence risk. We are not logged into any single system or platform. If a tool becomes outdated, expensive, or insecure, we can migrate clients to alternatives. Client data is always exportable in open formats, eliminating lock-in concerns. Finally, the client project segregation via the project equity method allows us to isolate risk. If one engagement underperforms, it doesn't drag down the entire project. Successful engagements can even be spun out as independent projects with their own cap tables and exit paths, creating optionality for enhanced returns. Let's address risk directly. Because every investment carries uncertainty, the transparency about mitigation is essential. First, diversification. We target a portfolio of 20 or more clients across different industries and regions. This reduces the impact if any single client churns or underperforms. Second, reserve funding. Before any dividend calculation, we fund 3 critical reserves: the buy now, pay later reserve, the contingency reserve, and the operating reserve. These reserves are funded from revenue before dividends are calculated, protecting your distributions. Third, security and compliance. We implement enterprise-grade protection. AES 256, AES 512, TLS 1.3, and in some cases, post-quantum cryptography is also active, for data in transit, role-based access controls, multi-factor authentication, daily backups, and 24/7 monitoring for anomalies. We align with the frameworks and compliance for multiple countries and also maintain cyber liability insurance to cover breach response costs. Fourth, committee oversight. Independent advisors review all of the customer-related performance, the financial performance, the risks, and the strategic direction quarterly. They also co-approve the Class B share transfers, adding a layer of governance beyond the general partner. Fifth, contractual protections. Client service agreements include clear liability caps, data ownership provisions, and termination rights to limit exposure. And critically, the project participation agreement explicitly limits your liability as a Class B shareholder to the capital you committed. You cannot lose more than your investment. If you are interested in participating, here are the concrete next steps. Step 1. Express the interest. Reach out to me directly via email at havar@atrc.net.pk or by phone at 92-343-270-2932. We'll schedule a call to discuss your questions, assess fit, and walk through the opportunity in more detail. I'll also send you the full draft of the project participation agreement for your review. Step 2. Review the project participation agreement with your advisors. We strongly encourage you to engage independent legal and financial counsel to examine the definitive agreement. This document contains all binding terms, risk disclosures, and legal obligations. We want you to invest with full understanding and confidence. Step 3. Complete KYC AML verification. To comply with the anti-money laundering regulations and protect all participants, we require identity verification, which is government-issued ID, proof of address, and depending on your jurisdiction and offering structure, certification as an accredited investor. Some countries require that. This is standard for private placements and ensures the project remains compliant across borders in all countries. Throughout this process, we provide supporting documentation. A demo of the project equity method dashboard so you can see the transparency firsthand, our silver pricing methodology with source references, a summary of our risk register and mitigation strategies, and sample financial projections based on conservative client acquisition assumptions. We believed in informed consent. Continuing with the participation process. Step 4. Commit the capital. Once your advisors are satisfied and the KYC is complete, you will wire funds equal to or greater than the value of 1 gram of silver on your commitment date. These funds are deposited into a dedicated project reserve account, segregated from other entity accounts for transparency. Step 5. Receive your shares and begin monitoring. Within 2 business days of fund clearance, the new Class B shares are minted at the prevailing silver price and recorded in the project equity method ledger under your holder ID. You will receive written confirmation with your share count and login credentials for the read-only project equity method dashboard. From there, you can monitor your investment in real time, view your share balance, track project revenue and expenses, review buy now pay later portfolio health, and see distribution notices. Once the first revenue trigger occurs, you will begin receiving quarterly dividend distributions via bank transfer or through digital currency. We also provide annual tax documentation to support your reporting. For any questions throughout this journey, you can contact me. My email is havar@atrc.net.pk or phone 92-343-270-2932. We are committed to transparency, responsiveness, and a long-term partnership. Before we conclude, critical disclosures. First, this presentation is for informational purposes only. It summarizes the key terms and answers common questions, but it does not constitute legal, tax, or investment advice. You must consult qualified professionals in your jurisdiction before making any investment decision. Second, investing in this project involves substantial risk, including the potential for total loss of your committed capital. There are no guarantees of revenue, profitability, or dividend payments. The first revenue trigger may take longer than expected. Client acquisition is uncertain. Technology or regulatory changes could impact operations. Past performance of the general partner or affiliated entities is not indicative of future results of this project. Third, the only binding document is the executed project participation agreement. All terms, representations, warranties, and risk disclosures are contained exclusively in the agreement. This presentation does not amend or supplement the project participation agreement. Fourth, we strongly encourage you to engage independent legal counsel familiar with private placements in your jurisdiction, a tax advisor to understand withholding and reporting obligations, and a financial advisor to assess suitability relative to your portfolio. Fifth, a structural note. At inception, the project operates under the project equity method framework within existing legal entities. The project is a contractual venture with ring-fenced accounting. This may change upon trigger events, for example, revenue scale, regulatory requirements, but any migration to a new entity would preserve your economic rights. Finally, your next action. If this opportunity aligns with your goals, schedule a call with me to discuss fit, ask detailed questions, and receive the full project participation agreement draft for your advisor's review. Thank you for your time and consideration.